everyone. Thank you for joining us for another episode of Coffee with Carl for our July webinar where we have special guest John Albertson with JP Morgan. He is the Vice President and Client Advisor with JP Morgan, and he's had over 13 years of industry experience. He works with some of the top financial advisors in the wealth management business along the East Coast, including Carl. So we thought he would be a great guest to have on and kind of pick through the market with Carl, share some news, some opportunities, and updates. So if you have any questions, feel free to share them in the chat, and we will go ahead and get started. Thanks for joining us, John.
Yeah, absolutely. And did you lose me? Am I still in the room here?
You're here, but you're on your phone. But we can go ahead and get started until you're able to join.
Okay. Yeah, for sure. So I apologize. I actually had some slides that I was planning on running through here today, but for some reason must have disconnected here. But we can run the 2-minute offense here today. But first off, I just want to thank everyone for joining us today. Thanks, Carl and Mary, for inviting me to join. I hope everyone's in good health and spirits and enjoying their summer so far. I know I have been. We're actually expecting our third child here in September. So trying to get as much in as we can before everything gets crazy again. But as was said, my role here at JP Morgan is to communicate our market views and really consult with financial advisors across the Northeast in building investment portfolios. And I can tell you, you're in very good hands with Carl, and he's backed by a great firm. But as far as a game plan today, was planning on just taking maybe the next 15 minutes or so to give a quick rundown of where we stand today. Really kind of just looking at the economic impact and future implications of what's going on out there. And then lastly, how do we invest in the current environment? So, if you judge 2023 by headlines alone, it could have felt almost as sobering as 2022, right? We had 4 U.S. banks that fell, alongside actually one in Europe. There was a lot of angst and anxiety around the debt ceiling drama that we went through, still all the geopolitical uncertainty as well. In addition to that, central banks have signaled that there's still a lot more work to do to win this fight against inflation. Yet, despite all of this news, the S&P 500 is up almost 20% so far this year in price terms. That is the fourth best first half in the last 25 years. Big tech has really put a lot of wind at our sails so far this year. And now we're finally starting to see this broadening out, right? Semiconductors, some cruise line, airlines, home builders, hardware companies. Some of these are some of the best performers over the last month or so. But what's to come, right? There may be some challenges ahead, but signs continue to point that, this economy is very resilient, right? And gains this strong that we've seen in the S&P so far this year tend to signal that the bear market is over. But what are we left with, right? And what we're left with is, and actually if you had the charts pulled up, we're actually looking at still some of the lowest consumer confidence that we've seen on record, right? It's actually in line with really the lowest sentiment that we've seen since the peak back in during COVID in 2020. What history has shown us is when sentiment is this low, right? We're feeling pretty bad about our financial situation, maybe the direction of the economy. It's actually some of the best time to put money to work. We should almost be doing the exact opposite of what we hear in the news. And if you look at the 9 times we've seen sentiment trough, right? So basically when we feel the worst about the economy, the 12-month return coming off of those lows is about 24% on average. The old Warren Buffettism: be greedy when others are fearful, and be fearful when others are greedy. And really, the biggest driver for some of the low sentiment we're seeing across the board is inflation. Good news is, the word transitory, which was the buzzword for last year, right? Everyone thought this inflation was going to be, this temporary beast, and it was just going to go away, and we are going to have get back to our normal lives. Unfortunately, it stuck around a lot longer than what we anticipated, but it is starting to turn over, right? You're looking at food prices relatively steady, right? We have fewer supply chain issues impacting grocery stores. We're also going through a little bit of an income squeeze on lower and middle class households, right? So that's kind of limiting demand a bit. Energy prices should be steady as the rising U.S. production comes online, right? Even offsetting the declines from OPEC. So good news is inflation is trending downwards. Some of the tougher news though, it's kind of like the show Biggest Loser. The first 100 pounds that you lose is pretty easy. It's those last 50 that tend to be a little peskier. But we do feel like by the end of the year, we could be close to 2.5% inflation or so. And potentially by the end of 2024, pretty darn close to that 2% target for the Fed. So we're heading in the right direction. But we have to understand yeah, go ahead.
I think what might be helpful too is when you're talking about inflation and how it's come down, how do you guys think around the framework of what that does to the market? So if we get, and obviously multiples are really important when having that conversation, but if we get back to 2.5, guys projecting out, and I think that might be helpful for some of the viewers just to get a better context of what it might look like if we can get down to those levels.
Right, absolutely, and a lot of it comes down to interest rates, right? So the Fed has a target of 2% inflation, right? And they're pretty gung-ho, hell-bent on getting us to that target. And what that means is they're trying to slow down the economy so that we're not spending at the rate that we have been. And really the main lever that they pull is the Fed funds rate, right? The short-term interest rate. And what that ultimately does is if they're pushing up interest rates, it's hard for us to gauge, what is a fair valuation in equity markets, right? So there's almost kind of an inverse relationship. When the Fed hikes rates, it really declines the valuations for equities, right? So when we get inflation in check and the Fed can finally step out of the way and take some of this uncertainty out of the markets, we can figure out what a fair value for a company would be today. Right, so ultimately, I think it helps us gauge the fair valuation of companies. It also helps them plan for future needs and ultimately how individuals will be spending their capital. Does that answer your question? Any follow-ups on that? Yeah. So inflation, again, that's kind of the big animal in the room here today. But we need to understand that volatility is normal in the marketplace. Right, we just came off one of the worst years since the financial crisis, right? The S&P was down 19% last year. But when we look back to 1980, the average decline of the S&P is right around 14%, right? So we were actually barely over an average pullback. But not only is volatility normal, it's also temporary. And as long as we've been able to stay invested throughout these volatile years, we've been able to finish positive over 75% of the time, right? So volatility is normal and volatility is temporary. And, when we look at the S&P itself here today, we need to realize there's still a lot of opportunity out there for us. If you look at just the top 10 names in the S&P 500 today, they make up almost 32% of the index, which is actually some of the highest concentration we've seen in decades. And if you didn't own those top 10 names here year to date, you've missed out on almost 90% of the returns so far. So as far as the opportunity set, we're looking at an S&P a little bit above fair value, right? Maybe a little expensive, but we need to understand a lot of that value is really driven by those top 10 names. And just because the S&P currently looks maybe expensive on paper for us, doesn't mean every name's expensive. And, the R word.
So are you
that
guys
no one wants to
expecting a
talk about.
big
Yeah.
broad?
Go ahead.
Maybe walk us through, John, when we're talking about the broadening out of the market, along the lines of where you think the opportunities, might fall.
Yeah.
I think there's kind of a consensus, the market's fairly valued, maybe overvalued, from a multiple perspective. But I think would be interesting, on that point is, where the opportunity exists at this point.
Right. Absolutely. And I think that's, so we work again very closely with our portfolio managers here at JP Morgan. We get insights into not only kind of what the economy is giving us, but also how are they allocating their portfolios currently. And one thing about, and I was kind of getting to this, but, the R word that no one wants to talk about, recession, right? It's a normal part and process of the business economy here in the U.S., right? I mean, you have the economy heat up. We have too much money chasing too few of goods. Price of goods gets too expensive. We stop spending, and then we kind of reset the whole process again. We also need to realize that recessions hit different parts of the economy at different times. And you can make a case that these big tech names that have really rallied this year, they almost went through a recession last year. They had earnings compression. They had, restructuring of their organization charts. They had the layoffs, right? So a lot of these boxes that get checked during a recession, tech kind of went through last year. These also are considered some of the safest companies in the U.S., right? Flush with cash. So they've been garnering a lot of attention just because of that quality. But now that we look at current valuations at the levels they are, we feel like it just might be a little overbought currently to be jumping into that space. So we have actually been pulling back a little bit from those mega cap tech names and looking at some of the other opportunities out there that are looking much more attractive from a valuation standpoint. And I would say a lot of those kind of fit into the value bucket, right? So, we want to be kind of careful around the financials. Healthcare, I think you can find some decent industrials, but that's, I think trying to complement some of that and some of the growth names and taking some of those profits and trying to get a little more balance is important. And, doing these client conversations. Yeah, go ahead.
Yeah, I was going to say for purpose of the call, I mean, when you see the NASDAQ up, 30%, or in that range year to date, and the Dow Jones and a lot of the value components flat or just up a couple percent, I think that really speaks to John's point about where the opportunity can come up. I think, at least myself, I'm from the standpoint of, this may be a great time to take some profits on those big tech names, just because in some cases, like NVIDIA, they're up 200% and 300%. So those dollars could be reinvested into some of those more value names that should still perform well as we finish out the remainder of the year, regardless.
Yep. Yeah. Absolutely. We're not really at this point trying to chase our tail, right? Because this recession certainly is a real possibility, and we're not really trying to chase that that performance currently. And I know artificial intelligence. We have we have a lot of conversations with our growth managers around that. That is certainly going to be revolutionary and evolutionary, right? And but we also need to keep in perspective is these first movers, I mean, Google was not around at the invention of the internet, right? So, the big winners in this space probably aren't even companies we're talking about today, right? So, I think having patience is going to be very important, really throughout that. And, even going back to, value outperforming severely growth last year, right? So just because it worked last year or didn't work last year doesn't mean it's going to work for this year. And, I think creating that balance ultimately helps us keep our emotions at bay, right? And helps us invest through those times of volatility.
John, when you speak with your portfolio managers, I think, we talked a little bit here about U.S. markets and kind of the growth versus the value trade. And it seems value probably opportunity. How are you guys thinking about international space?
Yeah, so I know this has been a very tough conversation really since, I guess, 2008, right? I mean, we're coming off basically a 15-year run where it was own U.S., own U.S., own U.S., right? So Actually, looking back the last 14 years, the U.S. markets have outperformed by almost 280% cumulative percentage points through that 14-year period. Right, so you weren't wrong with the U.S. allocation there. We also need to realize that during that time frame, the U.S. dollar was on an absolute tear, right, and it provided a lot of headwind for the international markets. We do feel like we're going to get back to this old stodgy U.S. economy once we kind of work out the kinks here of what COVID delivered. And we're actually finding some pretty good international opportunities, right? It is possible. International has outperformed in the past, but right now we feel like the dollar, is overvalued, right? And that'll eventually provide some tailwind. Going back to buying low and selling high, right, and negative sentiment, there's a lot of negative sentiment around international markets, which generally bodes well for future returns. The valuation story is, the international markets have also never really looked cheaper historically as well. So, I think you kind of have the currency, the valuation, and then all the sentiment going along with it. I guess, CVS is the acronym, but there's a lot of things pointing to why we don't want to be severely underweight international. Now, we're not going all in. If we were having this conversation a year and a half, 2 years ago, we were probably getting as low of international exposure as possible, but we have started to kind of leg our way back into international a bit.
John, what might be helpful for the callers, and one of the biggest challenges I've seen is when I look at 401ks, some folks are just 100% in U.S. markets and have just completely ignored international. I think John's trying to hit on the fact that international could provide an opportunity. Maybe would you walk you through, if you said, hey, in a 100% equity portfolio, what kind of allocation are you guys, what would you guys be looking at, just so people can have a little bit of a context?
Sure. So if you look at the All Country World Index, which basically looks at the capitalization of every country across the globe, the U.S. provides, it's about a 60-40 split between U.S. And then you're looking at 40% between like emerging markets and developed international. I would say right now we're probably more 75-25. Which I guess is slightly underweight the benchmark, but for your typical investor, that's probably pretty good overweight there. So I would say maybe 75-25 is really kind of what we're targeting right now as our quote unquote neutral allocation.
Perfect. Thank you. And folks, as we continue the conversation, certainly want to make this interactive. So if you guys want to send in some questions, I'll continue to fire them along to John. One question on the last topic that I think is helpful was along the lines of, if we do think there's may make sense to sell some gains, and particularly the kind of large mega cap growth. How do you guys think about that in the framework of cash? Because obviously right now cash is paying, money markets are paying 4 and 5%.
Yeah. I would say it really comes down to time horizon. So, I think money markets, CDs, I think that they play an important role for portfolios if you need that money on the short term, right? I think that guaranteed is certainly something that is very intriguing for a lot of people. But when we're thinking about CDs, it doesn't seem like there's a risk, but there certainly is a reinvestment risk that comes alongside it, right? And what I mean by that is right now we think we could see one more rate hike, maybe 2 this year, but we're actually pricing in potentially 4 rate cuts for 2024 and 4 rate cuts for 2025. What that means is if I buy a 1-year CD today, right, and it comes due in a year, I could very well be looking at much lower interest rates, and ultimately I miss out on the bond rally that comes alongside it. Right, so you have that opportunity cost with locking your money up, and then in addition to that, if we see some bigger equity pullbacks, maybe we see this recession that everyone's been talking about, we kind of lose that dry powder that we can deploy and take advantage of the equity rally as well, or the equity opportunity as well. So typically when we want to own cash and when rates are on the way up, when we see peak CD rates and starting to see rates maybe even cut, or peak Fed funds rate, that's when we want to make that transition into bonds. So this is really a conversation we're having right now as far as, when's the right time to start making that transition.
Yeah, and I think from the perspective of if we're thinking about conservative investments, right? If cash is paying 4 and 5, you can go, and John highlighted this, you can go to fixed income and do a core bond fund, and you could be making anywhere from 4 to 6%. Or there are other types of fixed income, whether it's credit, that it might be paying anywhere from 8 to 10%. So there's a lot of opportunity when we're thinking about if you're just trying to get yield, and you could certainly go out of those funds into the future. But the bond market, and I think, John, you could touch on this, the bond market is actually very attractive, right? Because if interest rates go down, the prices, the underlying price should go up. I mean, we saw, aggregate bond index 12, 13% that last year. I mean, that could be an excellent opportunity instead of, waiting around in cash. Because one thing I see is when people see 4 and 5%, they get really excited. But if you break that up over a 6-month basis, that's really 2.5. Over a quarter basis, it's 1%. It's not that difficult for you guys to go out there and generate a 1% return over a quarterly basis. And if we're thinking about just holding cash in the short term, you're not trading long term anyway. So you might as well go out there and try to make a one-off trade to kind of generate that extra return. So, John, I think context around maybe how you guys are thinking about the fixed income, just with the fact interest rates going down might help to, provide some insight for folks.
Yeah, for sure. So, coming off of last year, I understand why people have a very sour taste in their mouth around fixed income. It was actually the worst bond market in history for the U.S. aggregate, right? Down 13, 14%. And really it was because of 2 reasons. First off, we had 0 interest rates to start. U.S. aggregate yield was at 1.7. Now it's at 4.8. In addition to that, we went through the fastest rate hike that we saw since the 1980s. So these bond managers weren't able to keep up, and they didn't have a actual coupon to help steady that out. But today, as far as the opportunity set, first off, we have, the 4.8% yield. But even if we're wrong and rates go up by, say, 1%, we're only taking about a 1.5% downside. Whereas last year, if we were wrong, rates went up by 1%, we took almost double-digit downside. Now, if we see this recession, right, or, potentially see some rate cuts on the horizon, you could be looking at potentially, equity-like returns for owning a high-quality U.S. aggregate bond fund today. So it's kind of a simple math equation, but just long story short is the math is looking pretty darn good for us right now, comparative to maybe what even equity math is offering us from kind of a valuation standpoint, right? The give and take is much more in favor of fixed income.
How are you guys thinking about, all the time we hear, if recession, things go completely for the worst, which it turns out a lot of the doomsdayers were completely wrong at this point, at least so far.
Yep.
How are you guys thinking about maybe the trade, when we're thinking about like gold as an alternative asset class?
Yeah, so I would say alternatives is certainly something that we look at, right? So maybe some different hedging strategies. I think for long-term investors, kind of keeping an eye on where we're heading is very important, right? And trying to not use that microscope so often and continue to use the telescope, because long-term, staying diversified, having equity exposure has actually outperformed heavily versus some of those commodities. But, I think alternatives play an important role as far as, maybe trying to smooth out the ride for investors, right? But making sure we have something that's maybe a little more predictable, right? A little more consistent. I think after last year, we learned that, hey, stocks and bonds can move together at some point. So, having something that can maybe complement that in like a smaller sleeve probably wouldn't hurt us too bad, just to help kind of keep our emotions in check a bit. But yeah, I would say, long-term investor history has shown is like the markets have outperformed significantly over some of those asset classes though.
Yeah, and I think that's helpful for folks to realize, just because a lot of times these ideas are thrown at them, but they're always thrown from a more of a kind of salesy short-term perspective, as opposed to just letting equities kind of, right? I think you guys have one slide too, and just that really speaks to volatility. Would you be able to walk through that? How often, how many times a year you typically see a 5% move, 10%, 15% move? I think that would be really helpful when people just think about, hey, the markets do drop, but typically they do return fairly quickly, as we've seen over the last year.
Yeah, was that page 45 that you're referencing, or was that from on the bench?
I think you're right. It just shows the different benchmarks of like how many times 5%, intra-year, et cetera.
Oh, yeah. So that was, I think that was kind of some of the stats that I was talking about earlier, where we kind of, if we look back at the S&P since 1980, we average 14% pullback any given year. So it's kind of the price of admission, right? And I think people understand that we're going to take some volatility from time to time, but that volatility does tend to be temporary, right? And as long as we stayed invested throughout that year, we've been able to finish positive 75% of the years since 1980. And I was trying to think as far as just market moves, looking back to 1980, I do know that on average, we have about 64 days where the markets move either up or down 1%. So again, just kind of going back to the sheer fact of, this volatility is normal, and as long as we can stay the course and understand that, we're focusing on that goal is the finish line, odds have been in our favor pretty severely over that time frame.
100%. And I think that's too why whenever we look at, for any of the folks that are in their 401k, your dollar cost averaging. So they're excellent tools to, be, if you have a longer time horizon, to be heavily weighted towards equities, because we know the market's going to rebound. And if you're constantly making new contributions, you're going to be able to, anytime the market drops, it ends up becoming a, excellent opportunity for you.
Right. Yeah, absolutely. And, even from like a balanced portfolio, right? I mean, obviously we understand equity markets are going to provide that volatility, but since 1950, as long as I stayed invested for 5 years, right? So think about all the bad things that have happened in the last 72 years, wars, pullbacks, 9/11, right? The financial crisis. If I had just a very simple 50-50 mix between stocks and bonds, as long as I stayed invested for 5 years, I actually would have never experienced a negative 5-year period, right? My worst return would have been 1% per year, as long as I stayed the course for 5 years.
Yeah, I think that's really powerful to think about for, all the concerns, all the conversation around recession and what it's all going to mean, but market consistently does, continue to move to the upside.
Yep.
And John, one sheet that I thought was helpful, and maybe this might give an idea too. I guess my concerns may be more so when it comes to recession, or probably a little bit more into next year, if anything. How are we doing when it comes to just cash on the balance sheets? Because I know that's been one of the big things. Consumers continue to stay strong. How are you guys thinking about that? When that kind of goes down further, and then when folks have paying student debt, is that potentially an area of concern for you guys?
Yeah, so I think it's certainly going to have an impact, right? I guess as far as talking to our economists, they don't. The student debt is certainly going to have an impact, but a lot of that is kind of concentrated in some of the lower demographic of the U.S. here as well, right? So those really aren't considered the quote unquote spenders of the U.S. So it certainly could kind of dampen some things as far as top line spending, but nothing that's going to be a huge concern. But yeah, I mean, I think that's, the consumer is really what's going to help us kind of land this plane, right? And that's really the story of this year, is the consumer has been very, very resilient so far. But when we look at what's to come, we're actually looking at some declining savings rates, right? Some of the lowest savings percentages that we've seen since like the 1960s here in the U.S. We're starting to see debt levels picking back up a little bit. All that excess savings that we had from COVID, right? All that money, which actually was about $2.1 trillion we saved during COVID, could potentially be dry by October of this year. So that's certainly, going to cause some changes. But on the flip side, everyone's still employed, right? We have some of the lowest unemployment numbers that we've seen since the 1960s as well. If I get let go by JP Morgan today, there's still close to 10 million open jobs out in the U.S. waiting for someone like me. So, there's kind of a give and take relationship, but we do feel like there is going to be some sort of, people are going to have to choose. Okay, where am I going to spend my incremental dollars? What am I going to have to cut, right? And ultimately that could lead to some sort of slowdown or recession. But we also kind of have to realize, again, going back to that tech story of recessions hit different part of the marketplace at different times. So, it doesn't mean everything's going to, drop at the same time. But I think it just kind of goes back to that patience and making sure that we're pretty well balanced.
And I think the biggest point you hit on earlier, I mean, the market really is just looking, it's really still an inflation story. So, as John mentioned, we're expecting some rate cuts. So as the cost of capital goes down, the equity markets can trade at higher valuations. So ultimately, even if we do see some recession in some capacity, it doesn't necessarily mean the stock market, Main Street may take a hurt, but the actual markets could continue to go up. So I think that's really important to remember. And while we have a couple minutes left here before we finish up, I wanted to open it up for any questions. If you guys want to go ahead and send some in before we finish up here with John today. Any other final comments on your end, John, before we're waiting to see if there are any questions?
Yeah, I mean, I think, again, it's diversification is going to work again, right? I mean, right now the bond market's screaming recession, but the equity markets is kind of like my 5-year-old son, it's just not listening to anything we're telling it. It's continuing to push on. But, if we do see this recession, we do feel like it's going to be more on the mild side. And all it's going to do is just create opportunities, right? So I think, we're in uncharted territory. I mean, making sure we're pretty well balanced and kind of getting back to basics is going to be important. And if we see this recession, we could probably take advantage of some really good opportunities in equities. If we don't, equities are going to rally off of that news, and bonds are in a really good place again as well. So, I think these are kind of those once in a decade opportunities for us. But unfortunately, we're still dealing with that COVID fallout here, right? So some weird things can happen.
Yeah, for sure. And I mean, and one thing folks to remember is, and part of the reason you're starting to see a lot of the market continue to run, even, becoming a little expensive, is a lot of folks were in cash, and a lot of the portfolio managers necessarily weren't fully into equity markets. So they also missed the boat a little bit. So you're seeing, more and more people go from cash into equities, which continues to push the market up. So one thing to remember is too, just like if you're the folk that has cash currently, the market does pull back just like anybody else. Folks are looking for opportunities to get in. So, even if the market does pull back slightly, and we're not certainly expecting anything, pretty dramatic, I think those would all end up being, excellent buying opportunities, as John mentioned, from a long-term capacity.
Yep.
All right, with that, up here a little past 12:30. So with that, I'd like to thank everyone for joining. I'm going to go ahead and get a copy of the slides, and I will provide that to everybody, as well as we will have this taping available in the coming weeks for people to view if they'd like. And feel free, obviously, if you guys have any questions, feel free to reach out to me. John certainly can be a resource to us at JP Morgan. So once again, thanks, John. Appreciate you, and hope everyone has a wonderful rest of their afternoon. Take care.
Absolutely. Thank you.